welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is July 21st of 2022. This is our market insights and observations, and thanks for watching. It's a hot one outside here in Palm Desert, California. It's about 117 degrees a little bit later today. That's why I'm not wearing my jacket right now, because there's a heat wave across the United States, and so we're seeing everything heat up. Hopefully the markets continue. They had a pretty good day, couple of trading days this last week, and we actually had a trading range that we're squarely in. I'm going to talk about that in a minute, but let's go back to the economic data at hand right now, as well as the corporate earnings, because that's what's moving the markets in the short term. You know, corporations are basically coming out in their second quarter reports, and the C-level executives like the CEO or the CFO in their earnings announcements are saying, hey, listen, on their conference calls, they're going, hey, it was a less bad quarter or upward surprise. And ultimately what that means is it's not unexpected. Numbers have come down, and they're coming down for the third quarter. It's called earnings revisions, and basically just managing expectations. No different than my children. My children come home and say, hey, listen, I just took a test, and ultimately I don't think I did that well, Mom and Dad. So they're managing our expectations. Hopefully we get a B out of this, and they come home with an A or a C to a B relative to whatever it is. And hopefully it's A's. That's what we expect in the Schein household. That being said, once we as parents get the upward surprise, or it's less bad than we thought it was, kids are just doing, or CEOs are doing the same thing we all have done when we were in school, managing expectations. And that's the classic game of Wall Street. The good news is corporations are coming up with upward surprises and less bad sort of earnings reports. So that's sort of helping us right now as we go through this, the summer sort of grind, if you will, with regards to the markets. Now, next up, we're seeing the cooling of housing. That data just came out, and mortgage demand is down 6%. It's a 4-week in a row. It's a trend of a decline in mortgage demand. In fact, mortgages have basically come to a grinding halt. If you think about it, the earnings affordability has just come down significantly since the year to date. Buyers and sellers, the equilibrium in housing has to help out. So it's not just a market where you're getting over asking. Now you're going to basically say price reductions, and we're seeing that. And the mortgage affordability is now factoring in. So this is the lowest level that we've seen since mid-level of 2000 with regards to the mortgage demand, completely cooling off right now. So 2000, that's 22 years ago. So that's just gives a significant reference point to see sort of how this economy is actually slowing down. That's exactly what the Federal Reserve has wanted to do. In fact, I'm using an old chart here instead of having you go back and watch all my old videos. I'd love for you to do that, but I'm just going to go through a few videos, or excuse me, a few charts today that were previously in videos that I talked about in the future, what to expect. And so I keep these charts so that we can repurpose them and see, hey, how do we do? Rob, how do we do on the, hey, what to watch and what to pay attention to? Well, as I said, stocks and bonds, the Fed's target, right? We had this in a video before. 6 months ago, they targeted the stock and bond market, okay? They want to pump the brakes on the economy, especially in the equity market, and they've done just that. Crypto market, again, that's a $3 trillion market that's now down below $1 trillion, and that's, $2 trillion just evaporated from that marketplace. It's not something that we trade in. It's not something that we recommend or advise on, but it's important as it relates to the significance of the economy itself, because that $2 trillion coming out of the economy has a negative wealth effect to the GDP and a few other things. Again, now real estate is the next 6 months. So the next 6 months, which we're in at this moment in time, the Federal Reserve is pumping the brakes on mortgage-backed securities. They're not buying them as much now. And so that's also sort of hindering sort of the prices of, or actually jumping mortgage rates, ultimately bringing down the mortgage affordability. So the Federal Reserve's master plan is actually playing out in real time. And I talk about this. Now, is it a soft landing? Who knows? Will they over-tighten till something breaks? Potentially. The Federal Reserve simply has the opportunity to do that. Next week, we're going to find out more. On the 27th, they meet. It could be 75 basis points. I think that's square in the sights of them. We believe that inflation's rolling over right now, which is good. It's giving cover for the Federal Reserve to basically only do a measured 75 basis points. And ultimately, what are we watching right now? Jobs. The initial jobless claim report that came out was positive because claims have gone up. As I said before, the Federal Reserve is going to go after, or you can't have a recession without the jobs market rolling over. So now let's go to what we talked about here on recession warnings. How do we know we're potentially either in a recession? Well, we're double dipping in terms of retesting sort of the 2s and the 10s. The 2 years, so the short-term interest rate for U.S. Treasuries are higher. At that time that we did this broadcast, the 305 to 295, and we're still in that range. The twos are higher in terms of a yield than the 10-year. That's a recessionary warning. It happened late March, and it still is happening right now. So the bond market, by way of interest rates and way of pricing treasuries, is indicating to basically the authorities like the Federal Reserve, hey, be careful, don't overdo it because we're potentially in a recession or at least a fragile state of the economy. And this is our warning sign on the dashboard of the economic spectrum. Another warning sign is the oil, copper yields. They're all down at the same time. That really only happens if you're in a recession. So it's a recessionary indicator. In fact, next year in 2023, pricing of interest rates, there's actually a downtrend of what interest rates could be seeing. So meaning that the Federal Reserve could be lowering, the market's betting right now in the Fed Fund futures that they're going to lower interest rates in the back half of 2023, potentially because of this, right? So at the same time, the job market weakness, I talked about this, going back to March of 2000. Now we already had a data point today about March of 2000 level, which is mortgage demand level. Lowest level since then. But this is specifically talking about the job market, right? You can't have a recession without the job market rolling over. Again, the initial claims just came back and they're basically rolling over. And so that's what we had happen back in 2000, and now in 2021 here, we're seeing the same thing once again. Now, does the market have escape velocity? Are we in a trading range? Well, earlier this week on 7/19, today's 7/21, we talked about the moving averages of the target range. And so the S&P essentially has moving averages where it basically is either range bound or it has to basically have resistance or even sort of a support, if you will. So we watch the 200 moving day and the 50-day moving average for the S&P 500 specifically. So basically we're in the same range. The good news is that the current level is above, the current level S&P right now is at 39.85 as I film this, and it's above the current 50-day moving average of the S&P 500, 39.18. All we have to really pay attention to, don't spend too much time on this, Rob, because it gets really technical, but we want to make certain that the 39.85, the S&P, watch how we close today, watch how we close tomorrow into the close. The last hour of trading on a Friday is going to be very indicative. And the next week, we have earnings from big tech companies. Now, I can't say the company name specifically because compliance really doesn't like that, but let's just think it's an orange tech company, but it's not orange, it's something like an orange, okay? They're reporting next week, and that could give us sort of either a bottom in the market if they have positive, or that could potentially set up, we're gonna go down below the 50-day moving average, and that could be sort of a sign of where we are. Are we in a trading range? If we're in a trading range and we stay within this bandwidth here from the 50-day to the 200-day, we then start making some progress as to what I call escape velocity, what traders are looking for. A lot of what we're seeing is short covering. A lot of Wall Street's basically betting that the market's going to go lower. However, if again earnings continue to do better and we start getting better economic data, like the initial claims this morning, even though it was a negative news that more people are looking for sort of jobless claims, that still helps, takes pressure off of the Federal Reserve, which means lower interest rates in the future, which means higher earnings multiples for tech companies, if you will. It's all sort of inverse related, but it's all very important. So we need the economic data to slow down so the Federal Reserve can slow down so that earnings can then catch up and corporations can sort of, get sort of that escape velocity they're looking for. But we're also going back to the charts. Again, my beautiful intern, my oldest daughter, Taylor Schein, put this together. So I asked her to put the S&P 500 chart yesterday. She drew this for me from 2000 to 2023, and then from 2006 to 2009. Ultimately, these are the moving averages. So what we basically are seeing is the escape velocity. We really only need to see when the moving average of the market, when the 50-day goes above the 200-day. So this is the 50-day right here in blue, 50-day back then in blue, and when it crosses on the upside, that is a positive sign. So this is a plus 90% reading from a technical standpoint back then, historically speaking. Now, where are we today? We are making some progress. I don't expect you to see this, but it's not exactly matching this, but we are making some progress on this side of things right here, on this side of things. So it's good. we're seeing some good signs. We just want to make sure that we're staying in the range so that we have continued escape velocity. So the key is going to be how we close today, how we hold up in a Friday close into a weekend, and then next week what the Federal Reserve says, what they actually indicate, what they signal, as well as what the additional earnings from corporate America report. So we're making a lot of headway. It's all good at this moment as we're working our way through the summer. So stay cool out there. Thanks for watching and listening. I went through a lot today, so if you have any questions, please feel free to send them in to us. Give us a call, any one of us, and we're happy to help you, walk you through, and see how it's relevant to your particular situation as well. Take care and have a great day.